Well, hello everyone. Welcome to Trading a Smaller Account. We've got lots of red on the screen today. But for us in this Trading a Smaller Account class, that's not necessarily a bad thing, because if we know how to trade options, we can trade to the downside. And our second most successful year of practice trades in our Trading a Smaller Account class was actually the year the market tanked. And so all we have to do is take a look at the opportunities out there and take a look at what's going on in the world and figure out how we might benefit from that. So that's what we're going to look at today. We're going to focus on, making hearts out of the red on the screen, things that we love to look at, which is a profit. And we have some trades to review. We've got a bunch of new trades to place. So I can see the chat blowing up. I want to thank all of you who are here with us live, participating in today's class and being so participatory in the chat, because it really helps bring this class to life. So to Dominique and Josh and Rocky, Raccoon and Elizabeth and Sharon and Frank and Rojo and Will and Janet and Cameron and the rest of the gang, thank you all for being here. We also have the pleasure of having the fantastic Mr. Ben Watson with us in the chat today. So if you've got questions, ask away, and between Ben and I, we'll do our best to answer those for you. If you aren't following us in the land of X and LinkedIn, you're missing out. So you can go find us on LinkedIn. On X, it's Barb Armstrong CS and Ben Watson CS. So, be there, be square. These are additional free resources that are available for you to take advantage of, and a way for us to communicate with you and you to be able to communicate with us outside of webcasts like this. So just before we get into the thick of things, and man, oh man, have we got a lot to talk about today. It just, a reminder that options carry a high level of risk and aren't suitable for all investors. You have to apply for option trading privileges with Schwab. The paper money software application on the thinkorswim desktop platform, that is where we place all our example trades. And it's a brilliant place to learn and hone your skills and make sure you understand your trading plan, and then how to make that happen on the thinkorswim platform, how to make those trades happen. And so we do lots of example trades in this intermediate level class. And I say it's an intermediate level class because I'm assuming that you know what a long put vertical is, that you know what an iron condor is. And sometimes I'll do a 15-second description of what these strategies are, but we do move pretty quickly. So gratefully, these webcasts are archived. The majority of you actually listen in the archives. And so if I'm moving quickly, you can always, rewind and watch it again. Okay, know that there are some nuances or differences. One is that short option positions will never be assigned early in paper money. That can happen in a live account. Now, have I seen it happen? Yes, I have. Now, if you aren't catching Kevin Horner with his trader talks at the market open 4 days a week, you are missing out, my friends. Fridays, he talks ETFs, so that one is not archived, but the rest are. But I suggest you may want to show up on Friday mornings live to catch that. We're going to do some new example trades, and then we're going to manage some of our existing positions. I also filled in yesterday for Connie Hill in her long verticals and diagonals class, and we talked about long verticals yesterday, and I placed 5 example trades. So if you missed that class, you may want to go and watch that in the archives, because I said I would be following up on those in this class. And one of the things that we discussed yesterday at some length, I might add, was the fact that, if we look at the SPX, Chicken Little, it's now official, she's out doing laps, because, we're continuing to see this break. It's well below the 10-day, that the red is 30, and this is a 100-day moving average. If we were to if I were to make this a 200-day moving average, we're probably getting down into that neighborhood. Let's see. So, yesterday it was flirting with it. We're crossing that 200-day moving average. And, that's not a sign that warms the heart. And this pullback thus far, we're looking at over 6%. So, it's got a lot of people feeling a little nervous. Their accounts, if they're invested in longer term bullish positions like stock ownership positions, it's kind of one of those where your accounts don't look as lovely as they did a month ago. And nobody likes that feeling, right? But if we were to take, part of a larger account, and, we started at the beginning of this year with 25,000, and we said, we're going to place some short-term trades, and our goal was to earn $100 a week or $5,200 over the course of the year. And, we aren't out of March yet, and we've achieved that objective. But, we achieved that objective probably in the first 6 or 8 weeks. And we've been doing a lot of treading water, lately. But you know what? Base hits. We haven't had any, hugely profitable trades. We've had a lot of little winners. And then we've had some little losers as well. Okay, so let's go. And the first one I had up was Meta. But when we look at whether it's the S&P 500, the NASDAQ 100, it too is, breaking below that 200-day moving average as of yesterday. The Dow, this is Crimea River everywhere we go. And when we look at the VIX is up. And this is kind of in the nosebleed section. This is high. If we look at a 2-year chart, to be this high, we haven't been in that 25 range very often over the last 2 years, have we? And so can we look at what's going on with some different stocks? And if we're going to be bearish, and today we're hugging a bear, it might behoove us to pick stocks that have already been downtrending. And so if we come and we look at Meta, it's had a tough year. This last year, and this is only 9 months, but we've gone from almost 800 down to a low of 581. And then the way I've drawn my lines, and there is an art to technical analysis, but we saw this series of higher lows, and it's now breaking below that. And when we're looking at a market that can turn on the basis of a tweet, how do you trade that? And how do you trade that with confidence? And so some people are just saying, well, I'm just not going to trade this at all. I'm going to just, sit it out. Or, some will say, I want to keep my time horizon shorter than I normally would. And so in yesterday's class, the long vertical class, we did a short put vertical, we did a long put vertical on Tesla. And we put that trade on yesterday. And because volatility was where it was, we were able to do a long put vertical at 395 and 390. And it was already trading below that and get a reasonable price on it. And our target was, if this goes, the value of this long put vertical goes up by 25%, we'd like to take the money and run. And it hit our target on that today. And so we're normally with a long put vertical, and often we kind of bracket the strike. So, and by that I mean, this is a bearish strategy where we're saying, I'm going to buy a put because I'm bearish, but this is, a $376 stock. So, and we can risk how much in this class? Around 500 is our max risk per trade. So chances are, if I wanted to just buy a put, I couldn't afford to buy a put on Tesla because they're too pricey. And so I'm going to buy a put and then I'm going to sell a put as a way of subsidizing the purchase of this put. And the idea is that the goal is for the stock to go through both strikes and then stay below both strikes. And that's how we end up with a profit. Now, if this is a $5 wide spread, we typically will say, like, if we can buy it for $250, we could make $250. That's 100% return. And in our example trading plan, our goal has typically been to make a 50% return. So we're saying if we can buy this for $250, even though we could make $250, we'll get out at $375. And if we can make $1.25, we're going to be happy campers. And what we said yesterday was, given what's going on internationally, responses to tweets, what's happening with the Strait of Hormuz, like all the things, like maybe we don't have to go for a 50% return. Maybe we could be a little less greedy, or, just recognize the volatility in the market and say, hey, if I can get 25% and I can be in a trade for just 2 or 3 weeks or less, like in this one, we were in for 1 trading day and we were out, we're going to consider that to be good news. Okay. Now, if anybody is here for the very first time and they're saying, okay, she's talking about some example trading plan, where would I find this? Well, I like that question. And so this is one of the resources that I created and that everybody has access to. And this is where all the archives are. So if you missed that vertical class yesterday, the long vertical class, you can just come to the archives and watch it. And, there was a lot of good content in there, if I may say so myself. Then if you scroll down to these trade management mini sessions, so there's a bunch of really short videos on different candlestick patterns. Then this next group is example trading plan. So here's an example trading plan, and it just gives you a structure. And we go over the, what to buy, when to buy, how much to buy. So how much are you willing to risk? When do you get out, both if the trade is going for you and against you? And then what is your daily routine? Okay. So there's an example trading plan. And then yesterday we also did 2 long call vertical trades. And again, we said, hey, we typically go for a 50% gain. We're going to tighten things up and just say, hey, if we can make 25%, let's hit it and quit it. And we can always do it again. We can always do it again. And there are some stocks where we've done long call vertical after long call vertical after long call vertical. We've done 5, 6, 7, 8 of them before we moved on to another stock. Yeah. And so the deal with these is if you're up 25%, you hit the target and you're out. If you're down 25%, you're out. And we aren't putting it in as an OCO order. And why is that? Because of the volatility in the market. When the market first opens, it can sometimes whip you out for a way bigger loss, and then the market settles down. So instead, we just come and we say, okay, here's our long call verticals. And 2 of these we put on, we wanted to be out when we have a 25% gain. That's Micron and KMI. Are we down 25% on either of these? We are not. So our analysis is done. On target, we wanted a 50% return. And that means if we're down 50%, we get out. Are we? No. Now, Microsoft and Tesla, we put on yesterday, and both of those hit that 25% target. And we made, it was a base hit on each one. And we're out of those. Lennar, we're up 8%. So that was the 3rd long put vertical we did yesterday. We're up 8% on that one. Is it close to 25? No. Are we down on it? No. Analysis done. Okay. Okay. So that's that. Okay. So let's go back to Meta. And Meta's been kind of on the struggle bus. It had this diagonal support breakdown. So it's broken below this support level, and it looks like it's going to keep on going. Now, this is a $595 stock. So somebody's asking, OMK. So this class is taught Mondays and Fridays. I filled in for Connie Hill yesterday and did a long vertical class and said I would follow up on these because I don't normally teach that class within the structure of this class. Okay. So if you want to see what we covered in that class yesterday, you can go back and watch that recording. Okay, so here's Meta. And so when we see this breakdown on Meta and think it might continue to the downside, this is a pretty expensive stock. So one of the challenges can be when you come to the monthlies is that sometimes these are $10 wide, but Meta is so heavily traded that these are still $5 wide strikes. And so this is sitting at $595. Could we sell the 600 and buy the 600 and sell the 595? And you know, this is a $22 to $23 option. That's $2,300 worth of risk. That's way more than the 500 that we're willing to take. And if you look at our trading plan, it says, does this trade 1 million shares a day or more? Check. Do we have lots of open interest and or volume? Yes, check. Do we have a bid-ask spread that's tight, like less than 10% of the, the options, the bid-ask spread? And it's like 25 cents on $2. It's 1%. So yes. So we're going to look at buying a vertical, and that's going to cost us $228. $228. Now, how far does this have to go, fall, for us to be at our max gain? It has to fall by 60 cents and then stay there. Now, if on Monday it goes down below $595 or by the end of today, are we automatically going to make our max gain? No, because there's a time component and a volatility component. But at the end of the day, if it goes below $595 and continues to stay there, this trade should be successful. And so if we said, well, in a normal world, we might go for a 50% gain. But if we're going for a 25% gain, we're going to take our 230, we're going to multiply that by 1.25. We're going to say when this is worth about 288, now the price is going down. So we'll call it 285. I'm going to right click. So at 223, we can buy 2 of these, right? That's still below $500. We're going to right click and create an opposite order and say when this is worth 288, we want to buy it back. Sorry, 288. We want to buy it back. We're going to make this good till canceled. Confirm and send. So the most we can lose here is $450. Saying the most we can make is $576, but we're saying, hey, you know what? We're willing, if we can make, $120, $130, we're going to take the money and run. And the reason is because of all the uncertainty. Okay. We're just tightening the leash a little bit. Okay, so that's that one. Let's look at Dash. Okay, so here's another one. This is another stock that's been on the struggle bus. When we look at it, it had a high of 228. It came down today to 153. That's not a 50% loss, but it's getting close to that, right? We're down 45% from the high back here in October. So that's a whole lot of pain. And then it seemed to find this bottom of around 160 and came and hit it once, twice, 3 times. Yesterday, it was kind of flirting with it. Today it's breaking below. And so could we look at that? And again, you know, just look at an opportunity to perhaps profit, potentially profit from something that's moving to the downside. And again, with these, if it's a $5 wide spread, could I do that 160, 155 again? Like sometimes you just have to pay so darn much for it that you can't really do that. But if we do the 160, 155 again, does it trade more than 1 million shares a day? Check. Do we have lots of volume on the options? Check. Do we have a tight bid-ask spread? 65 cents on 11. You know, so that's maybe 5%-ish. So if we're saying, yeah, it's less than 10%, we're good. So if we look at buying a vertical, what do they want to charge us for that? $253. $253, and it's 57 cents away from the lower strike. You know, so the probabilities, if we want to look at the probabilities on this, if we come up here to this 155, you have a 50% chance of it being in the money. This is what this is saying at expiration come April 10th. Oh, I've got, sorry, I meant to do the 17th. April 17th. Oh, you have a 60% chance of it being in the money at 160, a 50% chance, 51% chance of it being in the money at 155, a 98%, it's just that it'll at least kiss it. Here we've got, you know, an 82% chance of it hitting the 150. And maybe by the time it goes down to the 150, that's enough of a drop for us to, you know, get our 25% return on this. I'm getting pretty good at calculating 50% returns in my head. The 25s I'd have to work on. So I'm going to change this single order to a first trigger sequence. We can do 2 of these. And then I'm going to right click, create an opposite order. And again, we're trying not to be greedy. That was just what was up. You can use blast all or first trigger sequence. So I'm going to take that 253 times 1.25. So when this gets to 316, we're going to take our money. And you might say, that just seems like such a pittance. But you know what? It's a 25% return. And the last 2 of those that we placed yesterday, we already hit today. Now it's paper money. And there's also, you know, transaction fees, $1.30 a contract to get in and another $1.30 per contract to get out. And we're saying, I know the potential profit is $4.94. We're going to be much more modest. If we can make about 120 on this, we're going to take the money. Okay. We're going to put that in our long put vertical bucket. Okay. So somebody's asking about a max risk on the whole account. So, you know, if you're risking 500 per trade, there are times we might have 10 trades on. And usually it's a mix of bullish, bearish, and neutral, depending on what the market is doing and what individual stocks are doing. So although it's highly unlikely that they would all go wrong at the same time, there is that possibility. So if we had 10 bullish trades or 10 bearish trades in a row, and then the market jumped back up and took all of those out so that we had our max loss, you know, it would be humbling. It would take us back to our starting balance for the year, you know, if we lost $5,000. But if we have exits in place and we're following our rules, you know, one would expect that we wouldn't end up, we're position sizing with these for max loss, but our intention is to get out if we're down 50%. And so if we meet that intention, then, you know, it's still a flesh wound and it's still going to hurt. But you have to take risk in order to see some kind of reward. somebody asked about, I think it was a short put vertical on Apple, and I think that we closed that one out. So Apple we're out of. Now, here's the problem with something like Mickey D's, which expires today. And we are way in the money on both strikes. Now, if neither side is exercised, and that will not happen in paper money, if the short side is not exercised, then you're good to go. Like, because this will hit expiration and both sides will be exercised. And so you'll take your max loss. But in a live account, what if you decide to go out this afternoon? So I had put in an exit on this and it didn't get filled. What if you had put in, you know, you decide to go out for the afternoon and it's your live account, and where's my short put verticals? There we are. And the short strike gets exercised. So all of a sudden with McDonald's, and it's a $300 stock, we had 2 contracts with McDonald's. Oh, we have 3 contracts. So we now, you know, on McDonald's let me just close this. We now have 30, 60, 90 some $1,000 worth of stock, and we only have a $30,000 account. So then you've got to be watching and know that you then have the right to exercise your right to sell it at, you know, $322.50. But if you're not paying attention, you know, and it goes into close, then that would expire and you'd be, you know, it would be exercised and you'd have the profit on it. But now you own 90 some $1,000 worth of stock and you don't have the money. So you're going to get a margin, what they call a margin call. They're going to say, hello, you need to deposit a bunch of money or sell some stock. And, you know, it's just more angst than what any of us want to deal with. Okay, so this is why short put verticals, we want to close them out prior to expiration. So with Target, we've got 28 days. AMD, we have 28 days. Now with J&J, I closed that one out this morning. Our strikes were at 235 and 232.50. The stock is currently sitting at 236.20, and I closed it out for a very tiny profit. But at 236, we're $1 away from being in the money. And, you know, something happens this afternoon, the whole market starts to tank. Like, this stock is moving down today. So even though it's still above, if it closed below the short strike, this is where you can get into trouble, because at expiration, if this 235 is in the money by even a nickel, it's going to be exercised, and then the long strike will expire. And it'll expire worthless because it's out of the money. And then depending on what happens on Monday, you can end up losing way more than your max loss. And that's not a place we want to be. And so, you know, part of your rule or your trading plan may be, I do not let short put verticals or short verticals of any type, you know, just go into expiration because of that risk of it potentially expiring in between the strikes. And then there's the assignment risk that the short strike is assigned. And if you're not paying attention, then, you know, and you don't assign the other side, exercise your right to sell. Now we're, you know, you can be in real duck soup. So not where you want to be. Okay, I'm going to get off my pedestal now, but this is important, because if you don't understand this, there have been people that have made tragic decisions because they thought they'd ruined their lives. And you aren't going to ruin your life if one trade goes bad. but it's better not to create that anxiety for yourself of having, 4 times your account value assigned to you because something, either, was exercised and assigned to you, or it was assigned to you at expiration because it closed in between the strikes. That kind of angst we don't need. Okay. Yeah, so somebody's saying they feel uncomfortable taking these trades into the week they expire. And you know what? My bad to leave some of these until some people will have as part of their rule set, no matter what is going on, the Monday of expiration week, they will close out the trade. And that can be part of your rule set. That's part of your sleep at night factor. Okay. Yeah, somebody's saying they were assigned on McDonald's, and that can happen. And so if you're assigned, so we had a short put vertical on McDonald's, and the further it is in the money, the higher the risk of assignment. And then the closer it is to expiration, the higher the risk of assignment. So if this were in a live account, the possibility of being assigned is certainly higher. And if you haven't been assigned, you could be assigned right up until the market close. And so, this is why you want to exit that. But when it's this deep in the money, it can be hard to exit that position even for your max loss. And so this lends credence to that, get out ahead of time. And we were kind of flirting with this because it was flirting with our strike level. And then the stock just tanked. Okay, so let's go look at another one. One I wanted to look at, we've had a lot of questions on it, is Nvidia. So we had done a couple of iron condors on Nvidia, and we just did them 2 weeks out. Again, we're just trying to keep things kind of close to the chest. For those of you who are card players, so that other people can't, you're minimizing your risk of exposure, so to speak. But when we look at this, we were given a $41 credit per contract on the call side of this. And we put this in as an iron condor, and we put in an exit, but the short call is worth only 2 cents. So maybe we ought to close that out. And so, rather than with Nvidia just saying, hey, we want to buy this whole thing back when it's worth 18 cents, let's cancel that order. There we go. And then we can come back down here, and let's just look at the chart. So the idea with an iron condor is you're creating a credit spread sandwich where you're saying, my belief is that for the next 2 weeks, this is likely to stay below 195 and above 170. And it's been, doing this with one small digression to the upside, for many months now. And so this is called legging out. And we have only 1 week to go. But if we look at this, and what, many brokers will do is if it's a nickel, worth a nickel or less, they don't even charge a transaction fee to get out. And so we want to close out the call side of this trade for 2 cents. You know what? I'm feeling like a big spender today. I'll give them 3. And so we're just looking to exit that side of the trade. Okay, so we're out of that side. And now when we come back to our monitor tab, we can say, okay, this side, we were paid 48 cents to get in. So if we can get out of that for 9, we'll take it. So we want to buy this vertical back to close it out when it's worth about 9 cents. And keep in mind, like time decay is going to keep like working its little magic. Fire in the hole. Okay, so that's our management on Nvidia. And we did have another trade earlier on Nvidia that today was expiration, and both sides had hit their mark. Okay, so let's look at CrowdStrike. Okay. So somebody's saying, why not trade a short call vertical with the VIX being high? Okay, I really like this question, and I really like the logic you used in asking it, because when volatility is high, why not? But short verticals usually take longer to reach their target because time decay is a component of it. Now, if the stock moves down dramatically, it might hit that target. But, you know, the way I drew this line, and some might say, well, I don't like the way you drew it. You know, I would have drawn it this way. And, you know, you can draw it any way you like. But either way, you know, if this is our diagonal resistance level, it's now breaking down below that. And so with CrowdStrike, could we do the same kind of thing? Now, could we come up here and sell a short call vertical at 450? You know, maybe like something, we want to be above this line, right? And where's this line? I don't know, 435, 440. Maybe we could sell the 440. Would be nice if we could sell the 450. So, you know, we could compare these two coming out to April 17th. Now, April won't work for us because these are $10 wide spreads, the April monthlies, but maybe we could go out 3 weeks and do that. Could we do the 450? We have 62 contracts, 430, 565. That's $1.30. That's too wide a bid-ask spread for us. So, you know, that's a negatory on that one. How about looking at that long vertical again? Could we do the 420? We have 1,100 contracts. We have less than $1 bid-ask spread on the 420 and the 410, and it's already at 410. So we're just exercising some patience here. And typically you have to pay more for them, but then it has to move less. Like if we do the 410 and the 400, it has to move down another $10. Now, you know, on an average day, this stock can move about $20 from top to bottom. So it's not like $10 is that big a move, but we're trying to keep the probabilities in our favor. And we only want that 25% return, right? Like our return on these is modest. So if we're paying $530, how much could we lose? $530. So we're only going to do one. And if we say 530 times 1.25, we want to exit when that's worth 662. Or if it goes down by 25%, we want to exit as well. Okay. Yeah. So Kelly is making a comment in the chat is to try and defy the odds by having a good plan and not risking too much capital. So, you know, I've talked many times about, you know, is this a rule or a guideline? And with our position sizing, that's a rule. Like, and we talked about it, especially at the beginning of the year when we were having success after success after success after success. And when that happens in your live account, especially, you start feeling invincible. And you start thinking, you know, that these trade management rules, this position sizing malarkey is for mere mortals, and you could be making so much more if you were just taking double the risk. And then something happens globally and you have 10 trades in a row that go wrong, and you're, you know, laying it on your bed in the fetal position, sucking your thumb, and you've blown up your account or created a lot more damage than you would have had you not been smitten with your own success. And I say this because I've seen it happen to people. Like this is why, Ben and I get on our bandstands here. So 528 was 662, I think 528 times 1.25, 660. Okay, so we're going to right click, opposite order, 660. And we're being less aggressive on this because it's already through both strikes. It just has to stay below. So another long put vertical. Now, why not just do a long put with a 1 ATR target? Well, we'd have to go way out of the money to do that. Like this, anything in the money, at the money, it's not in our snack bracket. But that isn't to say we couldn't buy something way out of the money. We could. But we haven't done long puts in a long time. Okay. So that's CrowdStrike. Now, people seem to love these iron condors, and I love them too. And I also love flip-flops, but other than this winter where we had no winter, flip-flops don't belong in Utah in the winter unless you're, in a steam room. But here we have UNH, and it's been going sideways here since the beginning of January, and it's sitting right in the middle of a channel. So could we do the equivalent of our credit spread sandwich, a short call vertical on the top, a short put vertical on the bottom, above 295, and then below 265. So we're going to come here to our trade tab. We want to be above 290. So, and we've got lots of volume here. So we're looking at the 295. We've got an acceptable bid-ask spread. So we're looking to sell an iron condor. And this is saying 430 because it's using 295 and 300 and then 290. What we want to use on the long put vertical side was 265. So we're going to come down here to 265 and 260. So we get 245 for that. And how much are we risking? $5 minus 245. So the most we can lose on this is 255. The most we can make 245. We're going to say, hey, when we've got 80% of our max gain, we would like to exit the trade. So we're going to right click, create an opposite order, say, hey, when this is worth about 50 cents, buy the whole thing back. And we're going to put this in our iron condor bucket. So now we have 3 iron condors in play. And this one, we're going out 21 days. Why did we pick 21 days? Well, we didn't want a $10 wide strike width. Okay, so guys, we've done a lot today. We've talked about some trade management. We've exited some positions. We've also placed 4 new trades, 3 bullish and, 3 bearish and 1 neutral. So we did a long, whoops. Oh, there's our iron condor. So we did an iron condor on United Health, UNH. We did long put verticals on CrowdStrike, on Dash, and on Meta. We exited a position on J&J. And then these 2 trades were trades we placed in the long call vertical on the long vertical class yesterday. These were long put verticals on Microsoft and Tesla. So guys, have a really awesome weekend. I am going to be playing with my grandson and my daughter in Portland on Monday, but I will be back next Friday, and there's bound to be a great lesson coming your way on Monday by those filling in for me. So thank you for being here today. Stay tuned. Lots of great content still to come. Bye for now. Oh, and last thing, hit the subscribe button. Don't forget to hit the like button. It helps move this up in the algorithms. And follow Ben and I wherever we happen to be, but particularly on X, Barb Armstrong CS, Ben Watson CS, and in the land of LinkedIn. Take care.